There are these price areas on the chart where the market keeps bouncing back as if it hit some invisible wall. No classic resistance, no round number, no moving average, and yet the market turns there with remarkable reliability. Today I'll show you what's behind these levels, the concept of dealer hedging. We've already shown and explained the basic idea and what this phenomenon is built on in another video. If you haven't seen it yet, I'd recommend starting there first so you have a solid grasp of the whole topic. Today, we want to focus specifically on the concept and the foundations behind what we call our Vanna zones, one of the most popular and important features in our level of interest software. And I'll show you not only the theory, but also how we actually put it to use in practice. Let's get started after the intro. Hello and welcome back to the TradeNeon YouTube channel. My name is Oliver Sparring, Head of Trading here at TradeNeon, and today we're once again diving into the mechanics that move the market from the inside out. Here's the plan for today. First, I'll explain briefly and in plain terms what Vanna even is. Then, what makes a bull zone and a bear zone. And finally, the most exciting part, why the edges of these zones, of all places, are such brutally reliable turning points on the chart. Quick foundation first for everyone who doesn't juggle option Greeks every single day. Vanna describes how an option's delta changes when implied volatility changes. Sounds abstract at first, but it's crucial because the market makers, the option dealers, have to keep their positions delta neutral at all times. When volatility moves, their delta shifts and they have to buy or sell the underlying to get back to neutral. It's exactly this re-hedging that creates buying and selling pressure directly in the market. So, through this mechanically forced trading, the market makers directly influence the price of the market itself. Now here's the part you need to remember. In the indices, S&P 500, Nasdaq, DAX, we usually have an intact spot-vol correlation, meaning when the price falls, fear rises and with it implied volatility. When the price rises, investors calm down and vol falls. Price down, vol up, price up, vol down. This relationship is the foundation for everything that follows. Vanna exposure can be positive or negative. The mechanics of how Vanna actually acts on the market are very complex, but there's a wonderfully simple rule of thumb that you can hold on to. Positive Vanna exposure acts like a magnet. It pulls the price toward itself. Negative Vanna exposure acts like a repulsion. It pushes the price away from itself, provided our spot-vol correlation is intact. Now, let's combine that with a position relative to the current price. Imagine there's a thick cluster of positive Vanna exposure above the price. Magnet above. It pulls the price up. Bullish. And if at the same time there's negative exposure below the price, that pushes the price up and away. Also bullish. This constellation, positive above, negative below, is what we internally call a Vanna Bull Zone. The bear zone is the exact mirror image. Negative exposure above, pushing the price down and away, and positive exposure below, pulling it down like a magnet. Both bearish. In practice, you don't have to pick apart every single strike for this. When you look at the cumulative Vanna chart on Volant, for example, you see it at a glance. A curve rising from left to right is a bull zone, a falling curve is a bear zone. One look and you know what kind of environment you're in. Alright, now it gets interesting. What happens when the price actually runs through one of these zones? This is where the key to the whole concept lies. The moment the price crosses a strike, the moneyness flips there, and with it, the Vanna exposure flips its sign. Positive exposure automatically becomes negative and vice versa. That comes from the S-shaped Vanna curve that some of you already know from our dealer hedging course, where we explain this entire phenomenon in depth. An example. Above the price sits positive exposure, a magnet pulling the price up. The price rises, crosses this level, and just like that, the positive exposure turns into negative exposure that now sits below the price. Now pay attention, because this is the part that almost always gets misunderstood. This freshly flipped exposure, negative exposure, below does not simply act as a reversal. It first acts as support, because if the price drops back, volatility rises, and with negative exposure, the dealers then have to buy. So they catch the pullback, a safety net. But when the price wants to push higher, beyond that, the whole thing flips. As the price rises, volatility falls, and now the dealers have to sell through that negative exposure. It slams the brakes on the price almost from the rearview mirror, you could say. This exact behavior is what we call the rubber band. The zone pulls the price back like an elastic. First support, then break, not a simple change of direction. And that brings us to the observation that's the most valuable one for us in practice. The edges of these Vanna zones, whether bull or bear zone, are extremely reliable support and resistance levels. Once the market has run through a zone all the way to its edge, it reacts there in a clear majority of cases. And not rarely, it then runs through the entire zone again to the opposite side. Why is that? In our view, there are three reasons that work together. First, the rubber band we just talked about. As the price runs through the zone, it then flips the entire exposure behind it, strike by strike by strike. What was a bull zone has, by the time it reaches the edge, effectively become a bear zone, and vice versa. So the price stretches its own rubber band that pulls it back. Second, the fuel runs out. Inside the zone, the hedging flows drive the price forward. At the edge, that exposure is exhausted. Beyond it, there's simply no meaningful Vanna left to push the price any further. So the engine sputters. And third, volatility. By the time the price has run through the whole zone, a significant move has already happened, and vol has moved along with it accordingly. At an extreme like that, often just a small stabilization is enough for vol to turn back in its normal direction. This volatility normalization then hits exactly the freshly flipped exposure and immediately creates counterflows. The beauty of it, this mechanism is symmetrical. It makes no difference whether you're in a bull or a bear zone. What matters isn't the direction of the zone, but the fact that running through it flips it. Now to the part you've probably been waiting for. How do you actually trade this? 4 steps. Step 1. Determine your zone. You open the cumulative Vanna chart, look at the direction of the curve, and identify where the zone begins and where it ends. These two edges are your decisive levels. Mark them cleanly on your chart. In our level of interest software, by the way, the Vanna zones are built in automatically. Step 2. Wait for the reaction. The mistake most people make is blindly slapping an order at the edge. Don't do that. Wait until the price reaches the edge and actually shows a reaction there. A candle that bounces, a stall, a first counter move. The edge gives you the location, but the confirmation comes from the price. The most efficient entries, of course, are the ones defined and confirmed through order flow. Step 3. Set your target. If the price reacts at the upper edge of a zone, your local first target is the opposite edge, the other end of the zone. This running through of the entire zone is exactly the behavior we observe statistically. And step 4, the most important one, risk. Your stop belongs just beyond the edge, because if the price breaks through the edge cleanly and decisively, your thesis is invalidated. Then the exposure flip is missing and the rubber band doesn't kick in. That's exactly when you want to be out. And please don't forget this. This concept is no holy grail. There are, of course, situations where the edges don't hold. The most common case is a broken spot vol correlation, when, for example, a big macro event shakes the market and volatility suddenly rises along with the rising price. Then the whole logic is turned on its head. And when a large institutional player with a deep book pushes through their own agenda, they can simply override the dealer flows. And please keep in mind, intraday the zones shift. The zones from the overnight session can be used very efficiently throughout the day, but the US cash session, of course, produces its own fresh flows and zones that you can take advantage of. For clients in our day trading program, we've built our own dealer hedging framework for exactly this, which lets them follow the hedging flows in real time over the course of the regular trading hours. Let's sum it up. Positive Vanna pulls in, negative pushes away. Bull zone means positive above, negative below. Bear zone exactly the other way around. The edges of these zones are your most reliable turning levels because running through the zone flips it into the opposite. The fuel runs out at the edge and vol turns. If this video helped you out, drop us a like. It helps us enormously to make this topic more visible. Let us know in the comments whether you've ever spotted Vanna zones on your own chart. And if you want to know how we display these levels live, head over to our website TradeNeon.com, where you'll find out more about our level of interest software, which delivers the highest quality dealer hedging data every day, neatly synced right into your charting software. Until next time, and good trades. See you.